Hello and welcome, everyone, to the Planning Perspectives podcast. I'm one of the two hosts today, Jamie Hopkins, joined by my co-host, Kate Duffy. Kate, excited to have you on.
Thanks, Jamie. I'm excited to be back as always.
So we're going to be doing a topic today that we actually, Sue, who we work with here, said she doesn't see a lot of. So we're going to talk about bonuses and how to make the most of them, which I think is a really fun topic, but it's different for lots of different people out there. So we'll try to break this down by different categories or periods of life, and then how to get the most out of this.
I think that's a great topic. So thank you, Sue. Bonuses are really interesting because we might think about them as something extra. We tend to categorize money differently and feel about it differently, even though the value of money actually doesn't change. So think about mental compartmentalization. We might think of like our home life or our work life, and we do the same thing with money. When it comes to mental accounting, we put different buckets of money in different categories, and we might feel differently about it. A bonus could feel like you've done a great job, and maybe you want to treat yourself. It's time. Did you ever have someone say, go treat yourself with that?
Yeah.
You know, if someone said that to you every 2 weeks when you were getting paid, you'd be in a different financial position.
Yeah,
so we
Parks
think
and
about
Rec.
it differently.
Treat yourself.
Yeah, treat yourself.
Yeah.
So it's interesting. We might feel differently about how money comes in when it's either quarterly or annually, but we really do need to have a plan around what we're going to do with this money.
Yeah, I think that's Aziz Ansari has that. He's the one that does that. I think it made its way back into a commercial recently too. That little clip, but. Yeah, well, you brought up the mental accounting part, and yeah, there's research done on, right, if you win money, right, like at the lottery or tax refund, which you might bring up too, and that people actually spend that money differently than they would if it is a bonus or a regular paycheck. Although it's the same amount of money, we just treat it differently in our mind that makes it feel like it's maybe more available for spending than it is some of our other income sources.
Right. And it could actually trigger emotional spending. So emotional spending is different than regular spending because what's happening is our feelings are driving our purchases. You might be inclined to impulse buy something if you feel like you have this extra set of money. And we know that when we title things, like if we're saving for retirement, we have our 401k. If we're saving for a kid's education, we have 529. When we name these things, we are less likely to invade them for purchases that we normally would not do.
Yeah. Well, it's the same reason why I try not to go to the grocery store when I'm thirsty, because I
Right.
I don't bring any food home. I just like 19 different types of beverages. And my wife's like, did you buy any food? And I was like, apparently not, just every different flavor of beverage and sparkling water that exists. And but it's a similar thing, right? That's that emotional side, and there's something driving us there. So Kate, let's talk about like how do we look at bonuses, right? Like the timing of those can matter too, like when we're getting them throughout the year, whether quarterly or annually, and what's some of your views on that, and how do we plan around that if it's different from a timing perspective?
So there's so many different things that we typically plan for in life. Some of them I just named, like you might be buying a first home, a second home, education. And when we think about, while bonuses might not come regularly, if we know that part of our compensation is bonuses. So we want to think about it from a very high level perspective and think about it as part of our regular income, even if it's not coming in our biweekly, weekly, however you're getting paid for that. Because think about this. If you get a bonus once a year, let's say it's $1,000, and for the next 20 years, you put that into the market, you don't spend it, and let's say 7% return. In 20 years, you're going to have near $45,000. Like that's a lot of money for being disciplined and putting a part of your bonus away every single year. So I think that there are different ways to think about it. When you do sit down and you're looking at your financial plan and your different goals, you might not know the dollar amount of bonus that you're getting, but maybe you could put a percentage on it. Like, and I am all for enjoying life and money. I think that you should peel off a little bit to do something, whatever it is that you want to do. But for the majority of it, could you peel off 10% for retirement, 20% for something else. Think about it that way. Have a plan for it. Because again, if we don't plan in advance, you could end up spending all of that money.
Yeah, and I would say I think the plan in advance is really crucial. And I'm going to add a caveat here because I have seen this occur once before, which was, and it occurs every year, but people actually pre-spend their bonuses, which I think can put people in a very dangerous spot. As we talked about, the probably last 15 years outside of 2020 in the United States, the economy's been really strong. So while not every company has hit its bonus targets every year, overall, it's been a really strong run. But when you go back to like 2007 to 2010, bonuses weren't occurring for a lot of people. 2020, depending on when you were getting bonuses, right? Bonuses were cut and people were still pre-spending those, saying, well, I'm going to get my bonus coming up soon. Then all of a sudden, company is not doing as well as you had hoped. There is no bonus. But it's also a good caveat, right? There's, while some people refer to things as bonuses, they could be deferred compensation plans, commissions, which are treated a little bit differently. Like you've actually like earned it versus, bonus systems at companies. It, typically is at least structurally a slight difference between the two on, whether the company has more discretion to pay it or not.
Right. And we talked about this too. It's the misconception of the taxation of bonus. So at the end of the day, your bonus is not getting taxed at this special schedule. It still is all ordinary income. You might see a little bit of extra withholding in a paycheck, but at the end of the day, it is taxed at ordinary income for cash bonuses, but it could be different depending on how you're getting bonused.
Yeah, and that's really important because we talked about that before the show. It's the biggest misconception I get, where I've actually had people be like, I'd rather get it in my paycheck than my bonus. And I'm like, well, why? They're like, so it doesn't get taxed more. And I'm like, it doesn't. End of day, right, to your point, the withholdings could be different depending on how your company chooses to do bonus withholdings. But that all washes out when you go to actually file your taxes. That could result in a little bit of money back to you in some cases if you over withheld. But sometimes bonuses I actually see more often go in the opposite ways. They tend to be under withheld because especially if you have two spouses that are working, they're probably not always rolling it up to the max tax rate. But if you have two high income spouses and then you roll all of their income up, likely that is new money being taxed all the way at the highest rates. And you might be under withheld there and actually have to make up for some of those bonus payments later on, which is really just a good planning point. If you're getting bonused, right, to understand how is it being taxed? Are you withholding enough or not enough? Or do you want to send some of that to your 401k or other savings? Some companies will actually allow you to pick some of that to automatically send. So you might fund your whole 401k contribution at the beginning of the year when you're getting bonus, which could be a nice way to kind of closer to automate that savings of it.
Automation is huge because if you do have a plan, we know, again, if we think about bucketing money, we're not going to evade something that has a name to it for the most part. But when we have these extra payments that we're going to get, automating is huge because it takes the friction out of having to make a decision over and over again. Again, you have the plan in place and you'll abide by the plan versus impulsively maybe spend some of that.
Yeah, I love that. So let's talk about executive bonuses, and we'll try to go through different caveats here. We'll go through kind of mid-career and more early career bonus structures too. So a couple of things that you see out there in the executive world, and I'll put the caveat on this one first is, kind of senior leaders, executives are often going to have more negotiating power on their bonus structure too, coming into a company, right? As you kind of look at a company might be more pyramid shape with fewer senior leaders at the top. They often are going to have more, right, individualization of their options. So you might have negotiated what yours looks like. So maybe it might be more deferred compensation or more cash, more performance-based or more equity-based. But you probably have all of those levers that you could pull. I do have this conversation. I had a good friend in the tech world recently that took a new job, and we spent like a whole, hour going through two offers he had, and I was whiteboarding it out and going over. And that was a little bit of the conversation, like how much of the leverage you pull back on cash compensation and base comp for more equity upside bonus structures in the future. And what's interesting, and I told him this, which he wasn't really thinking about it in this terms, but I was like, as a business leader, we're usually willing to trade off some cash compensation and base salary to give people more equity upside, especially in smaller companies because cash flow is really tight. And so you'd rather use some of that deferred payment type structures to get really good talent in the door. And for an individual, if you can maintain your lifestyle, though, already within those bounds of your base salary and cash bonus, I tell people, like, try to push more of that out into the equity one if you're able to negotiate that, because you actually don't need that cash today. So you can get essentially a better return on that by pushing it out into the future from the company perspective. It's not without risks, but that can work out well for people. So I think that's, when you're an executive, to think about that. RSUs and other equity-based ones, depending on how the company's set up, withholdings might actually not be there at all. There are some equity-based compensation structures where the company will withhold nothing. And so they might vest, and at that point, these options and stock vest, and you have to figure out how to make the tax payments yourself. So planning for cash flow on that, maybe using your cash bonus to pay those, super important. I know that you've gotten to work with some people here recently, similar situations, right, where equity's coming due and kind of managing those tax consequences.
And you want to be thoughtful about that. You want to work with a good accountant, and you also want to work with a good advisor that can help you through the different options there. When we think about mid-career professionals and the bonuses that they're getting, what are some of the things that they could do there? We think about definitely everybody should be preparing for retirement. So putting some of the money away in your 401k, which has tax benefits. If you're going for a traditional 401k, you get your tax deduction up front. If you choose to do a Roth 401k or a Roth IRA, you're paying taxes now, but you're going to get tax-free growth. But there is also the possibility for mid-career high earners to do the backdoor Roth, where you can put money in a traditional Roth. You don't get a deduction, but then you get to convert it into a Roth. So again, you have that the tax-free nature of the growth if you're taking it out within the rules.
Yeah. I think another one that we had talked about before was then charitable. Where does that land in here? So a lot of different options across the spectrum. I'll add one back to the executive one, and then maybe hear some for kind of mid-career back from you. But you do look at, like, donor advised funds can be great vehicles, but also you see sometimes that the more I'd say more this is when a company's being sold and you might have had equity compensation and now it's like you get a huge amount. It's starting to look at, is there some type of charitable trust that also makes sense here? Because in those situations, if it's a charitable remainder or charitable lead trust, you could donate, right, like $1 million and get a very substantial essentially tax deduction that year, but still maintain some control of the inflows or income off of these, or the remainder to your spouse or kids, depending on the structure. And you do see those used in very high income years. Typically, it is when, a company's being sold, but it could just be you had a great year, all the equity vests in 1 year, and you're trying to see, how do I bring down my taxes a bit here? And we can use that across the spectrum for people, as long as you're itemizing your taxes. If your standard deduction, it's not going to help much. But everyone across the board should be thinking in high income tax years, am I using charitable planning and kind of bunching a bunch of charitable stuff together in 1 year to get the biggest tax benefit? Could be a really valuable thing to do.
It can. And then there's other things to consider is part of the estate planning, which you've brought up, charitable funding, donor advised funds, thinking about education and 529 planning for your children or for others who are considering education.
Yeah, when you think about the 529, right, Pennsylvania, where we are, we have a very good state income tax deduction for 529. So while you won't get that federal deduction, you can fund, a lot. If you have like 5 kids, or if you said other people, you can actually fund 529s for yourself too, if you plan on going back to school in the future. You can rename beneficiaries on 529s too. So you could even fund it for yourself today, pre-having kids, and actually rename it for kids in the future. So there's actually a lot of interesting ways to leverage 529s. And if you're in a high income tax state, that could be a good way to reduce down those state income taxes Although with the 529s, we can't get a federal tax deduction.
And there is the 5-year rule on gifting. So if you do have a lump sum and you wanted to pre-fund 5 years of gifts into a 529, you have that ability as well.
Yes. And if you're married, you get your spouses, you can double it up. And all of a sudden you can do a lot of money very quickly into a 529, which is, a great way to kind of invest for the future, provide some tax benefits, especially in, high income years. So you got that really big bonus. That could be very beneficial. Now, remember, most of the time bonuses almost across the board, besides some of the restricted stuff, is really getting taxed at when you get it. So although you might have kind of quote unquote earned that bonus the previous year, because you're getting the cash in the following year, it's going to be taxed in that year, not the previous year. So your contributions right after you get that bonus are really the tax year that you're going to be impacted on. It's wild. There's been a lot of legal cases around this. So it takes me back to law school and remembering the boss that writes the check on December 31st and says, hey, it's on your desk in the office. And you say, oh, well, I'm off today. I'm not in the office. Well, that check was yours. You were taxed in that year by December 31st, not the next year when you went and picked up the check. So it was a very interesting world. But that doesn't happen very often anymore. Most people are bonused after the fact. But it still comes up time to time. Like, when do you really need to recognize that? It's kind of when it became earned and you were able to collect it, although even if you didn't walk in and pick it up off your desk.
Right. So what about those in the early careers?
Yeah. So early career, a couple things here. For the most part, you're not going to have as much control over bonus structure. If you're in more of a performance role, you could have more of a driver on like how the outcome of the year is, right? You're in a sales role. Part of your bonus structure could be sales incentives, and maybe you have some control of that. But for most people in their early years, it's going to be more company performance. It's going to be based off of a percent of your salary, and mostly going to be cash compensation. There's not going to be a lot of option for equity early on, although there are companies that have equity programs for all associates. It's just less common, right? So there's no perfect answer to this because it's a world that you can design as you want to create the culture and compensation awards for your employees. But I think just starting there is going back to the one is I do worry here that people pre-spend this because a lot of this, early associate, mass associate bonus is going to be due to the company performance. So if the company's not performing well, or there's not a lot of transparency into how your company is performing, which is an issue for people, like I just have no idea how well the company did. Public companies, other companies like that, you can track a lot better, right? They've got quarterly reporting on their earnings and you can probably track it back. So like 3 quarters through the year, if you really want to, you could pay attention to what your company's reporting and say, hey, like we're beating goals, we're beating estimates, we're probably doing pretty well here. I have some notion that we're going to get a bonus, but I don't want people to pre-spend them. And I've run into this where people have bought, new appliances and cars, and all of a sudden bonuses weren't going to be at the level they were expecting. And then they're like, well, how do I pay for this? Again, going back to, we've had a strong economy for 15 years in the US, but a lot of people have never been through a cycle where bonuses weren't paid for years. And hopefully that's not coming soon, but that can be part of the macro economy where you're going through different cycles where companies aren't beating their earnings and aren't making enough to give full bonuses out.
It reminds me of the National Lampoon's Christmas movie.
Yeah.
Where Clark buys the pool, but he doesn't get his bonus. And it's really important for everybody, really, because I've seen this across the board, is the emergency savings. But it's really important for those early career. If you haven't built up an emergency savings of 3 to 6 months, because if we do hit some of these economic times that might be challenging, and you're reaching for an 18 to 20% credit card to fund those, that could be a challenge. So thinking about the emergency fund really across profession levels, career levels.
Yeah, and a couple things on emergency funds. I know it wasn't the whole point of this one, but since it could be a great way to fund that with your bonus, right? Is put that aside. But then the next question becomes, well, how do we put aside, right, emergency funds? One thing that I went to years ago was actually consider Roth accounts as part of your emergency fund. And not that I want you tapping into them all the time, but I very much used my Roth IRA early on as my emergency fund. Like I didn't have that much money. So I would get to the end of the year tax time, get some bonus and say, okay, I'm going to fund the previous year now. Because with Roth IRAs, you can fund them all the way up to April 15th, the year
Right.
following your tax year. So I would wait, see, and then I got enough money. And I said, okay, so I'll put my, $5,000 at the time in. But I also mentally viewed that as my emergency fund because you can take contributions out of a Roth IRA at any time, income and penalty tax free. So then it allows you a kind of what I viewed as a dual vehicle, that it was functioning as partially an emergency fund in the back of my mind, but also as a retirement savings vehicle. And so it's kind of had a dual mandate because sometimes I worry that people say, okay, I don't have a lot of money, but I've got my emergency fund taken care of, but it's really sitting in cash in the bank and not earning a lot. Instead, I said, well, I'm going to make my emergency fund go to work for me. But there's some risk, right? There's a trade-off there on using a tax advantage account and investing it at the same time versus really holding a true emergency fund of just cash to the side. But I think when you're budgeting and figure out what do you have, I do think it's a reasonable one to at least take a look at and then decide whether it's going to be part of that emergency fund plan or not.
I think that's a great idea, Jamie.
Yeah.
But being aware of both the pros and the cons of it too is important.
Yeah, like it's not just for everybody they should agree to that, but mentally if you agree to it, it could become part of that plan. So Kate, I want to ask you this question too. So give me a little bit of a way to view, like if you were going to allocate out and break down how you're going to spend or use a bonus, especially let's keep it to this kind of our, early career associates. What would you kind of break down there from a spending perspective?
Well, I know it can be very challenging for really young people to think about retirement because it is so far off. You might be thinking about the next 2 years or the next 5 years, but in reality, you are the one who is taking care of yourself today and tomorrow. So if you can take a little bit of that money and put it into your retirement, if you're not already maxing that out, and you definitely want to at minimum contribute, if your company offers a match, make sure that you're hitting that because that's essentially free money. And then you might think about what are the goals that you have. And people might not necessarily think of goals. They might just think, I want to buy a house in the next few years, or I want to start an education plan. Look at the totality of what you want to accomplish and what you need to get there, and then decide how much of that bonus will automatically go there. Now, we know if you don't know the exact amount of your bonus, but you put percentages around it, like 10% is going to go to retirement. Maybe 50% is going to go to the house goal if you have that in the next couple of years. Thinking about it that, and then of course, taking a little bit of it and siphoning that off as discretionary spending. So you don't feel like you're not sort of taking care of yourself in another way as well.
Yeah, I mean, I've always viewed my bonuses over the years as trying to fund those larger savings goals that I always found difficult to do throughout the year. So I mentioned the Roth. I did have one where I told parts of this story before, but the first time I funded and opened up the 529s was right after a bonus. And I was in Vegas and I was speaking at a conference, and I went back that night and opened up the 529s and like put a good amount of money in there, right? I think I had 2 kids at the time, but put money in for 2 of the kids and felt like really proud that like I'm in Vegas, right? Just got a bonus and like went back and did 529 savings instead. But I do know for me, like the tax implications of it are definitely important. So I do think about at that time, should I give a larger gift to charity? One of the organizations I'm involved with, should I do more 529? Those tend to be the 2 biggest like other levers that I have, because at this point I've gotten better at automating my retirement savings. So I don't really need to do that one then. But now I've got these other 2 decisions, right? You've got kids funding and charitable. And those are really the other 2 levers that I really pull at this point. So I think, thinking about that ahead of time and saying, do you want to build that in then? I also see a lot of people, as you know, wait for their charitable decision to the end of the year, which, you could align it earlier and get it done early in the year and at tax time. Or if you're quarterly, right, you could align it with the end of the year, kind of bonus season too.
charities love to get their money throughout the year,
They do.
not just at the end of the year.
You're like a great shout out to all of our charitable partners out there. Like, we love money throughout the year, not just in December. They do have expenses throughout the entire year. Yeah, that's a great one. So Kate, one other one, I guess we'll kind of work our way through this last question. But you like to talk about planning for the bonus throughout the year too, just like giving. So when do you think people should actually start planning and coming up with a blueprint for how they're going to use their bonus?
Well, I am a huge fan of financial planning. So I think this isn't something that you're just making every year. This is something that you're revisiting every year. So when you think about, again, your income in totality, when you're doing your annual review with your accountant and your advisor, it's planning at that point in time. It is, what is the year? What do we think the year is going to look like from a life perspective and from an income perspective, and plan accordingly. Again, we might not know the dollar amount, but if we know what we're working towards, it gives us a little bit of an easier decision to say, okay, if we know we need to fund these buckets, how can we do that this year? This is not something that you should be coming up with on the fly when you get the bonus. Think about it well in advance. Make it a practice to be checking in on an annual basis, or maybe more frequently, depending on your situation.
Yeah, well, I love that, Kate. And, in the new years where we sit here, it's a great time to start thinking about it from the savings, the spending, the whole planning perspective. So really love that. And I don't know if you have an answer for this one, so I will give it to you. Then I'll talk for like 5 more seconds. So because we usually ask our guests, what's the best piece of advice they've ever received, or the best financial advice. So do you have a best piece of bonus advice you've ever received or given? And so, because that's a variation on it, but I'm going to throw that out there.
Variation on it. Okay. So this is where a little bit of my money psychology comes in.
Okay.
I'm a saver.
Yeah.
I'm a saver. So for me, it would be the best advice that I've gotten is save half your bonus. Like, save half of it for a rainy day, and actually use it at some point for the rainy day, whether it be retirement, whatever it is, but save half your bonus, because you never know what the future is going to bring.
Okay. Well, it's always sunny here in Philadelphia, so we never have to worry about rainy days. It's a little bit of a joke for those who don't know. We get lots of rain here in Philadelphia and the great state of Pennsylvania, Commonwealth of Pennsylvania, yes. Right? That's also a fun one. But thank you, everyone. Kate, thanks so much for diving into this topic with us here today. I hope everybody enjoyed New Year's, and welcome to 2026. Thank you for hopping on the show, Kate, with me today. And thank you, everyone else, for listening and watching the Planning Perspectives podcast. Make sure you subscribe so you never miss an episode.
Thank you for listening to the Planning Perspectives podcast. Don't forget to click the follow button to be notified when new episodes are available. Visit our website at www.bmt.com or call us at 833-973-7633. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investments, not a deposit, not FDIC insured, not insured by any federal government agency, not guaranteed by the bank, may go down in value.